All right, good afternoon and welcome to the Federal Reserve Decision Day. We are minutes away from hearing from Fed Chair Jerome Powell just after the Federal Reserve announced that they are keeping interest rates the same at least through September. So a lot to get into right now, and I want to bring in my guest for our conversation today as we wait for Fed Chair Jerome Powell to speak. We're talking with Joseph Wang. He's known as the Fed Guy, and he's the CIO at Monetary Macro. Joe, we just got the statement from the Federal Reserve. What really stuck out to you today? I'm looking at a line in particular that didn't change, which is that the committee said they do not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. I think a lot of people would have hoped to see that the Federal Reserve thought we were a little bit closer to cutting rates than this statement would indicate.
Yeah, you're right. There's a lot of people hoping that we get rate cuts soon. But the good news is that there are other things in that statement that also change that hint towards a rate cut. Most likely it's September. So the way the Fed operates is they're kind of like a super tanker. They move very, very slowly. Now they know that they're a very important central bank, not just for the US, but globally. So everything they do is telegraphed in advance. In that statement, you will also note that the Federal Reserve is now becoming more aware of two-sided risk. So the Fed wants to have full employment and also price stability, that is to say, low inflation. Over the past couple years, it's really all about inflation. We'd had unemployment very low, but inflation way too high. Where we are today, though, the Fed is saying that they are more concerned, becoming more concerned about unemployment as well. Now, just to recap, over the past year, we've seen the unemployment rate steadily increase now as high as 4.1%. Now, that's the Fed telling you that, we're a bit worried there, so we're probably going to be thinking about cutting rates probably soon. There's another change in that statement, and that is inflation, instead of being described as elevated, it's toned down a little bit. So that's acknowledging progress on inflation. So I would expect at this press conference, Chair Powell is going to strongly hint that the next move, a rate cut, is probably going to be in September. So for a lot of the consumers, I think relief is in view.
And we're going to get two separate monthly data reports when it comes to jobs. The big one coming in just 2 days on Friday for the July jobs report. What do we need to see? What are we expecting for Friday's jobs report? Again, as you mentioned, 4.1% unemployment. That's historically low, but we've been in an environment of much lower, historically low unemployment. And so that creeps up a lot faster.
So you're exactly right. The unemployment rate continues to be historically low, but it's at a trajectory that we don't really want to see. It's been steadily increasing for the past year. Now, historically, what we notice, and this is called the Sum-Dudley rule, that when unemployment increases, it tends to gain momentum. So it tends to increase at a fast rate, and eventually you find yourself in a recession. So that is not worrisome right now, but the trajectory is not good. Now, for jobs reports tomorrow, the expectation is we continue to create a robust number of jobs. But let's keep something in mind, though. Now, we've also had tremendous population growth in the United States. The Congressional Budget Office is estimating we had about 3 million migrants last year. Now, a lot of them are illegal, so we don't really know how many people are entering the country, and that continues to happen. So part of the reason we have job growth isn't necessarily that we have a robust economy. It's really just we have more and more people entering the labor force. Looking at the job demand side, a lot of surveys indicate that actually the labor market is softening. So we're in a labor market where demand is softening, but supply continues to increase. So that's part of the reason why the unemployment rate has been rising.
Yeah, the Fed famously says they have this dual mandate. Price stability is one. That's the inflation that we're looking at, but also maximum employment. So that's that balance between inflation and the jobs. We've talked about the jobs. I want to lay out where we are with inflation today. Remember, a couple of years ago, we peaked at 9% on the CPI. Today, we're at 3% on the CPI, so significant downward trends over the past 2 years. And in fact, the Fed's preferred inflation gauge is about 2.6% if we're looking just at core, 2.5% if we're looking at overall prices through the PCE. The Fed's target, we'll hear over and over again, is 2% inflation. A lot of people are questioning whether that target remains relevant in this type of economic environment? We have a pretty strong economy sitting at about 2.5% inflation. Is 2% too much?
Well, that's a hard question. You ask the other people, they'll tell you that maybe we should have 3% inflation, right? So this is ultimately a political decision. Now, just for some context, the Fed did not announce an inflation target until 2012. Now, when you look behind the scenes, a lot of historical transcripts, it took over a decade for the Fed to have enough consensus politically to say that we want our target to be 2%. So whether or not that's too high or that's too low, that can be changed, but it's ultimately going to be a decision by the people who sit in the FOMC, or maybe Congress can take the decision into their own hands. So if you're not happy, I think the right route is just to talk to your congressman. Now, to be clear though, to the Fed's target, as you mentioned, core PCE at 2%. Right now, that is indicating 2.6% year over year.
Right.
So by that measure, the Fed is not too far from the inflation target. Now, many people will look at their own grocery bills and feel like that, 2.6%, that doesn't sound right to me. Again, that's simply the rules that the Fed plays by. It doesn't necessarily mean it's a good measure of inflation.
Yeah, explain to me and to our listeners why we need inflation in this market. I've talked to about this a little bit before. Deflation is pretty terrible for our economy and would certainly result in a recession. Why do we need inflation year over year?
So that's a really good question. I think there are two standard reasons for this. First, from the Fed's perspective. So if you have inflation, that means you have stronger nominal growth. So let's say that means inflation. Let's say interest rates are above, let's say 3-4%. Now, if we had deflation, interest rates will not be at 3-4%, right? Now, if you have relatively higher interest rates, then when you inevitably get into a recession, the Fed can cut rates. It gives them some room to stimulate the economy. So that's one point. The other point is, let's say we don't have inflation. Let's say we have deflation. Well, that means that everything that you want to buy today is going to be cheaper next year. Now, when that happens, then why am I buying now? Maybe I'll just buy next year, or maybe I'll just buy even later because it might be even cheaper later on. Now, if no one is buying stuff, then businesses are going to suffer. If businesses suffer, they can't hire people. And so you get into what's called a deflationary spiral. And we see that sometimes throughout history. Good example would be, let's say, the Great Depression or the Great Financial Crisis of 2008. That's not fun. So through history, what the United States has decided and many other countries across the world have decided is that having 2% or just a little bit of inflation is okay.
Okay, let's talk about these rate cuts. What people are looking for, what markets are looking for, what investors are looking for is when that rate cut is going to be, the first rate cut since the pandemic. So we're talking about the first rate cut in more than 4 years. We've been on a rate hike campaign for more than 2 years now. It started in March 2022. And as the Fed just told us minutes ago, we're going to be on that for at least a couple of more months. And our Fed funds target range, this is what we're talking about when we talk about interest rates, but it really ripples through the whole economy. It's at a 2-decade high, sitting at about 5.3%. So that's where we sit today. But as we talk about this rate cut and when is it coming, and now maybe September, I know that the markets are really pricing that one in as for a September cut. Would it be a huge mistake if that September cut didn't come?
Honestly, the way that I see the markets, they're very eager to price in rate cuts. If we didn't have one in September for whatever reason, they just start pricing the next one in November. But I think it's very clear that cuts are coming. Now, I think it's helpful to understand why we don't have cuts already, even as inflation is low. So if you think back the past couple of years, the Fed has been really, really wrong about inflation. In the beginning, when inflation was surging, they were telling everyone that it was transitory, just go home, everything is going to be okay, and they were totally wrong.
Yeah.
And then
Yeah.
last December, they were looking at inflation and telling everyone that mission accomplished, everything is okay. And then we had inflation roar back again in the first quarter. So if you've been wrong so many times in the past couple of years, you're just extra cautious, and you're reluctant to make that mistake the third time. Now, the second reason why the Fed is just still somewhat reluctant is that the market has a tendency to get overreactive to rate cuts. So in January, the market was pricing in 7 cuts this year. Now, that's just too much, and it made the stock market go to the moon. That creates financial instability and also a lot of wealth inequality, right? So they don't really want to have markets to be too exuberant. So they're very cautious now. We'll hear what Chair Powell has to say during the press conference, but I suspect that a September hike is a very high probability event. September
So
cut,
what is
excuse me.
Yeah, yeah. Definitely not pricing in any kind of rate hikes or any indication of such. Um, as we're about 7 minutes away from Fed Chair Jerome Powell speaking, and we'll be bringing that here on this live stream, what sort of tone does he need to strike today, given, as we pointed out, some of the lack of changes in the Fed statement? What sort of tone does he need to set to, or what are people hoping to hear?
So I think people are, everyone wants to know when the rate cuts are coming. That's what really what, and they will ask that question in 1,000 different ways. And Chair Powell, very skilled, been at this job for some time, knows exactly what to say. He's going to bat that away. But I do think he's going to hint at the September cut. Now, the problem for him is that he knows that the market could very much overreact to this. If
Mm.
he hints too much, maybe the market prices in a whole bunch of cuts. And what that could do is that could make the markets go higher. It could make mortgage rates come down a lot, and it could reignite another inflationary cycle, just like what happened last December. So the tightrope he has to walk is to tell the market, yes, cuts are coming, but no, it's not going to be huge, and please don't overreact. That's going to be a very difficult path to tread.
Yeah, and we know for most people, the market is not the economy, right? But let's talk about how this rate cut would impact them. Here's the environment we're currently in. The 30-year fixed mortgage is sitting near 7% still. Credit card APR, your credit card interest rates, they're well above 20%, and it's coming at a time when people's credit card debt is at a record high. So what would a rate cut mean for people?
So I think the rate cut would have more of a direct impact on shorter dated interest rates. So credit card loans, I think, would have some relief. But to be clear, when we have cuts, it's probably going to be 25 basis points. So that's 1/4%. It's not going to be a big deal. What could be a bigger deal is when we have inflation come down more and the market prices in more cuts. When that happens, we can see longer dated interest rates come down as well. And so you could have a mortgage rate maybe with a 6 handle, maybe, now this is not guaranteed, but it's possible we could even see a 5 handle in the coming months. I think for a lot of consumers who have been sitting on the sidelines trying to buy a home, that's going to be a big relief. So that's what we have to look forward to. Now, I think that a big change between now and the pre-pandemic world is that the market doesn't think we'll go back to zero interest rates. The market thinks that the lowest we'll go is about 3.5% on the Fed funds rate. That translates to I think maybe a 5 handle mortgage rate. So things are going to be different going forward than they were before the pandemic. But I think things are going to improve from how they are right now when it comes to financing.
And how can we get those big swings on the consumer side of thing when we're really talking about a 1/4 point rate hike on the Fed side, or rate cut?
So
Wow, we're really doing this today.
so the way the market looks at this is that it prices in an entire path of policy. So not just what happens,
Mm.
let's say in 1 month, but also what will happen in the next few meetings as well. Now, when the Fed embarks upon a rate cut cycle, then the market feels more confident that the next cut is coming. And sometimes its imagination runs away with itself and then it prices in a whole bunch of cuts. Like I mentioned earlier, in January, they priced in 7 cuts this year, and we haven't had any at all. So it's really the trajectory of the stance of monetary policy that matters when it comes to interest rates, and making that big step from going to hiking, then staying still, and then cutting is a big step. And I think the market is going to take that and extrapolate how rates will be.
Our rate hike campaign that we saw was so dramatic, so quick, historic, really. How long is the descent going to be, you think? How slow is that process going to be to get to that neutral rate, which you're saying is going to be a lot higher than we've seen since the Great Recession?
So the market is pricing in about 3.5%, and that's like 3% higher than it was pre-pandemic. So The market is pricing a pretty gradual descent, and that makes sense to me. Now, if you look at our economy, even though things are slowing down, our recent data shows that we grew at 2.8% annual rate, and that's still a very strong economy. Now, something else that we should keep in mind is that the fiscal policy is very, very loose right now. What that means is that the federal government is spending a whole lot of money, much more than they're taking in tax revenue. Now, economists commonly think of deficit spending as having an inflationary impact. The Congressional Budget Office is estimating that the US fiscal deficit is going to be about 6% of GDP basically forever. Historically, that's very high. And if we happen to tumble into recession, historically, the government begins to spend more money to help the economy, and that could easily to go as high as 10%. So as long as you have a government that continues to spend a lot of money, that puts upward pressure on inflation. So I think it's very difficult for rates to really go back down to where they were before. And a lot of it, of course, will also hinge upon what happens in November. Now, the two presidential candidates have very, very different visions of the world. Now, we could end up in a world where we just have tremendous amounts of spending and less taxes and so forth, and that would put upward pressure on inflation.
Yeah, we haven't heard a lot from either candidate on specific plans related to this deficit, annual deficits we're talking about, the national debt that continues to balloon. We'll wait to hear more about that. I want to go ahead and make sure we put up the podium shot right now so we can be watching to find out when Fed Chair Jerome Powell is going to be walking up to the podium to give us his thoughts. And Joseph Wang has been giving us a lot of context about what we can expect to hear him say today. While we wait for him to walk up, I just wanted to ask one more thing, which is you mentioned a recession. And I feel like people have been predicting recessions for so long. It never came. Would acting too late on an interest rate cut be a catalyst for something like that?
Yes, that's definitely a risk, especially as unemployment rate has been rising for over a year. And I think that's going to add a sense of urgency to the Fed to try to shift to a softer tone and more strongly telegraph that rate cuts are coming, because they know that monetary policy acts with a lag. And if they act too slow, they risk losing the great economy that we have today.
And I know that that is a concern that we are starting to hear, is that if it doesn't come in September, it might be too late. A lot of this data is backward looking. Let's listen in right now.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing,
Given the number
and
of
transportation.
negative experiences I've had
Our
in the
monetary
past
policy
few years,
actions
I can't
are
imagine what a
guided
black guy
by our
goes
dual
through.
mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Howard.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut, and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market, too? If the labor market is back in equilibrium, why is restrictive policy, and potentially very restrictive policy given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates, and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions, and that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as we're actually in a good place here. We're balancing these two risks of go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected, so that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. we've seen, significant movement in the labor market. And, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this, we raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, as I think, unemployment was in the threes, mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have, we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most rate, you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and, frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months we're reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably under 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices, or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer-Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year, and the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
Thank you, Mr. Chairman. Edward Lawrence, Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports in the last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have we had a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction, whereas, I mean, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. I mean, just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more. If it starts to show signs that it's more than that, then we're well positioned to respond.
Is there a reason to think that the labor market might behave differently this time than it has historically?
I think history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amara.
Thank you, Chair Powell. Amara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the nonprofit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or a really bad economy. It's one of there are spots of weakness, and there are regions where growth is stronger than other regions. But overall, it's again, look at the aggregate data. Aggregate data is particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data, especially, it's very hard. GDP data can be volatile quarter to quarter. So it's just hard to measure economic activity. There are it's just difficult to do. So I look at both, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary. But we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. we're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
Hello, Jean Young with MNI Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go-around. And then this morning we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming
Yes.
inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question. That is the case. That, as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can We had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off any more for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market, so that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see. Which way the economy heads, and I think if we are to respond to weakness, we're certainly, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we have to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks. But nobody has great vision deep into the future. In terms of a reaction function, that's a long time discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.